join in.
Hello, tell me, how are you?
Hello, everyone. Good afternoon. Thank you for having me in this Zoom meeting. Thank you for the
Wonderful.
invitation.
Most welcome. Most welcome. We'll spend the next 20 minutes, 25 minutes talking about what the deal is. And then we'll again come back in this mode answering questions. So the easiest way, and they're basically just 8 or 9 core slides. Nothing much really in terms of, we don't have too many slides. So easiest way to look at it is this is an opportunity to invest in a value add multifamily, and this opportunity is my company Zenvista Capital is acquiring Vail Apartments. It's a fully stabilized apartment complex in Sealy. So this opportunity is all about why Whale is a good investment, what investment returns will you get, what is the economics behind this deal, all that good stuff. So to start with, it's a 60-unit apartment complex. Each building has 4 units. So each building is a standalone fourplex with 4 units. So we have 15 buildings sitting on its own land lot, and we have 60 units in total. All units are 900 square feet, 2 bedroom, 1 bath, perfect for growing families. That's the standard configuration we have. And at this stage, this opportunity is open only for 506C investors, means accredited investors only. The easiest way to find accreditation is one of two ways. One is your net worth, or second is your income. So, for being accredited, your net worth minus the equity in your primary home should be at least $1 million as of the date, or your income should be 200,000 or more in the last 2 years as per the tax returns, and the expectation that you will hit the same 200,000 in 2025 also. If married filing jointly, the income goes from 200 to 300. So these two are the most common ways of qualifying as an accredited investor. There are other ways where you have a FINRA certification, all that. Most of the cases, normal investors would not have those certifications. So those are the things. So currently it is open only for accredited investors. When I started raising, I had kept one full month for 506B, which is friends, families, their friends, families, students in the master's program, knowing somebody, so on and so forth. But after that 1 month had passed, we got almost $1 million of investment in the 506B. Then I had to open it for 506C. So we don't have a way to go back to B. So currently it is in 506C. As we go forward, 1 second. This is a standard disclaimer. 3 takeaways is this is not an offer to participate. The real offer comes when you sign the documents, which is private placement documents, and I countersign it. That's when we agree to an offer. And then please consult your CPA, accountant, attorney before making any decisions. Past performance is not an indication for future, so on and so forth. Standard disclaimer that SEC asks us to provide. Everything you see here is SEC compliant. We have an attorney who looks at every single detail and tells me what to speak, what not to speak in 506B, 506C, so on and so forth. As we go forward, from a sponsor team perspective, and this again goes back to what roles can the GP play. So from a sponsor team perspective, we have Zenvista Capital, which is my LLC. I did, and you see the bullet points. I found the deal. It was an off-market deal. Worked the price with the broker. The seller agreed. I'm going through the acquisition, which means all the steps required to work with the attorney, seller, contract to close, the loan servicer, etc. And then I'm also raising capital along with other capital raisers like Andrea, and I have two other capital raisers also. I'm jointly on the loan with Massive Capital. I will manage the asset management, and ensure we all get a profitable exit. So those bullet points are the GP roles that I'm playing from Zenvista Capital, my LLC. Now, massive capital, essentially only Sanjay is participating. He is coming jointly on the loan and he is bringing his balance sheet because I don't have any relationship with Freddie Mac and it's a Freddie Mac loan. Sanjay has already taken two prior loans with Freddie Mac. So he has a relationship and Freddie Mac will look at it more positively when the packet comes to them. Oh, this person, oh, we have known him. He's our past client. So I'm bringing him as a balance sheet partner jointly on the loan. Massive is capital raising, but maybe 200, 250 or something like that. And we are splitting asset management 80-20 between Zenvista and Massive. So Massive is like you do the asset management. If you need any questions or something, we are here. So they are taking 20% of it, and then I'm sharing the balance sheet piece of GP with them. So those bullet points are the roles that we are playing as GPs. Quick one. This is a qualitative slide. This is how the building looks. This place is in Sealy. So everybody who's in Texas, Sealy is 15 miles further west on I-10. I-10 is where the oil and gas corridor is, KT is, and further west of I-10, as you go to San Antonio, you will find Sealy. So just now, Houston is the fourth most populous MSA in United States. As Houston is growing, the sub-markets like Humble, Conroe, Sealy, they are also growing. 85% of the tenants living in Vail Apartments are commuters to Houston Oil and Gas Corridor and which is the other corridor, the warehouse corridor on Brookshire area. So because of that, their median income is 70,000, which is pretty decent. And Sealy is a perfect place for most of the commuters because they are working from home and traveling to office 2 times in a week. And when I speak to them, they are like, we are easily saving $500,000 to $600,000 every month on income, on rent, just by traveling 15 times 50 times to 30 miles only during the commuting day. This property we keep calling stabilized financing. So out of we bought this property at 5.9 million, which is a little less than 100,000 per door. But the total cost of this project is 6.5 million because with 5.9 million you add closing costs, acquisition fee, reserves, capex, all that. So it goes to 6.5 million. We are getting 4.4 million, between 4 and 4.2 million. We are getting funded with Freddie Mac. We are getting an agency loan at 6.45%, and that is funded by Freddie Mac. They constantly look at properties which are stabilized. Stabilized means the occupancy rate is 90%. This property in entire 2024, 93.3%. From January to May, almost May, 91.5 to 95%. So it's very high occupancy rate. That's the major criteria that qualifies us for an agency loan. Apart from that, I talked about 60 units, 1982 build, significantly renovated in the last 4 years by the current seller. And purchase price we talk about, the money we are raising is 2.4. This 2.4 can be 2.5 depending upon how much loan we are getting from Freddie Mac. So they have given us a range, 4 to 4.2 million. If the range is on the lower side, we'll raise 2.5 million. If it's on the higher side, we'll raise 2.5. Projected returns, we have two classes. I'll speak about those classes and returns extensively as I go to the next slide. Location for everybody who's in this area, we spoke about it. Sealy is in I-10. We have warehouse corridors, oil and gas corridors with existing so many jobs. Tesla, this is public news, is opening a mega factory for battery storage units. 850 jobs is the first tranche of jobs coming in January 2027. So this is like Sealy will significantly benefit due to this new factory coming up. A median income is high. We already spoke about. I-10 has easy access to 99, 90. So, it's very well connected. Most counties, even Harris County has property tax rate of 2.5 to higher percentage. But this county is just 1.98. So we'll benefit out of that. A median age of our tenants is 38 years. So they have quite a few years to live peacefully in a good place and keep on contributing to the tenant base given their ages, because this is the perfect age for a growing family. Having said that, the biggest question, and then most of these slides I prepared for Freddie Mac, and I'm sharing exactly the same slides for the investor because I want to have a single source of truth. If there were just three slides I had to share, this would be one of those slides. So the biggest question is, when you buy into this multifamily, somebody is doing a syndication like us, taking money from all of you with an expectation that you will get a certain increase or certain return at the end of 5 years, and also preferred return every year. So where does that come from? That comes from the fact that you go through a structure called value addition, and this value addition is essentially going to increase the value of your property. During the years while you are value adding, you will earn more income, you will probably tighten your expenses, and therefore increase your net operating income, which is your profit and loss, consider profit. And as the net operating increases every year, at some point, you will decide that I will do a sale, and the value of your property, unlike single family homes, here it is calculated based on net operating income. So I'm buying this property apartment complex as 375,000 net operating income, and the plan is to take it to 600,000 in 5 years. And it's a doable plan. I'll talk about it. And because the plan takes it a net operating income to a higher number, you divide by cap rate and get a higher value. So property goes from value A to value B, and that's the time I sell it and distribute the profit to all of us. So the entire plan here is value add opportunity. Increase rents, decrease expenses. So let me go through that discussion. So value add, there are two pillars, interior and exterior. Interior, currently there are 57 units out of 60 which are rented. Three units are not rented. Why? They have used one fully furnished unit. So they have two types of unit, classic and upgrade. And there is a $175 $200 differential for upgraded units. They have vinyl planks and good appliances, all that good stuff. So they are using a fully upgraded unit as a leasing center. Person who's a leasing agent is coming thrice in a week, 2 to 3 hours. I'm like, why don't you come more often? So he said, I don't have any reason. I have 57 units rented. So why should I come? So I said, what if there is a walk-in? So he said, no, there is no walk-in. I have a board here. They have to call the number, take my appointment, and then I'll give them a tour of the property. I said, okay. So he is essentially blocking that leasing unit, which is not configured. It is not configured to be a leasing place. It is exactly a unit which any family can move into. He only has a small table and some storage space there. So freeing up that leasing unit will give us $15,200 of annual rent. How will you free up? By putting a remote leasing and remote repair program in place. This property is currently already having remote repairs. You call the 1-800 number, raise a ticket, somebody will come fix it. That is already in place. Remote leasing, there are property management companies, less than 100 those they do remote leasing. We have a property management company that we contracted with, who is managing a property across the road, which is 0.015 miles. It is right 0.01 miles. You cross the road and that's the property. She said, so we contracted with her. He said, that's a double size property that she's managing. Oakleaf Management. They are like, we are perfectly okay to work with our leasing center. I will add more people. We will service your apartment remotely. If somebody calls, we will just cross the road, show them the apartment, etc. We can do that. So remote leasing is possible, and I keep calling it remote, but it's actually just a stone throw from my property. So because of remote leasing, that property goes into the market. Now, the other two units are model units. I said, why do you need two units? Oh, this is classic, this is upgrade. You want to show the difference. You don't need that. Keep one unit and keep the pictures of the other unit to give them an idea, or put a video together or something. So, out of two units, one unit goes to the market. So, 15,200 for that. 30,000 by doing nothing, just moving those units out in the market. Now, we also looked at the tickets for repairs. And there are so many small tickets. Change the carbon monoxide alarm, battery is beeping. So small. I mean, the cost of doing that is less than $5-10, but the cost of somebody coming is $79. And we saw gazillion tickets. I'm like, this is a colossal waste. So, what needs to be done is proactively we hired a due diligence company, and we did a detailed due diligence by walking all 60 units, and we made a note of what is broken, what is not broken, what needs to be fixed. So proactively we put $500 budget, which is a huge budget, per upgraded units, 31 upgraded units. Go to the unit, fix all of these proactively. Change the filter, put the carbon monoxide battery, whatever is little is broken, fix it. So that way you will avoid the smaller tickets for the entire year. That said, so that is number three. All these things, putting two units in the market, minor touch ups to that, all this can be easily accomplished within the first 3 months. I'm giving it 1 year. So 1 year is a good enough time to accomplish this. But the major amount is coming by capturing or upgrading the 29 classic units. 29 out of 60 units, almost half, are classic units. So I put some bullet points in terms of what I need to spend, upgrade these units, and capture the rent differential. And I'm giving 1 to 1.5 year for this. So honestly, to upgrade 29 units can be done in 4 months, 5 months. But I don't want the unit to be empty. The unit, I want it to be rented as much as possible. So once in a year, every unit comes for renewal. I will wait. So we have put a workflow together. We will wait for the unit to come to renewal. We will say that, okay, now the renewal is going to be $200 extra because we are putting so many upgrades. If they don't agree, they'll probably move out, and we will proactively find a tenant. We'll say, hey, why don't you join in a week or whatever? And in that meanwhile, we will fix all this. The time taken to do that selected upgrade is 4 days. Two teams, 4 days, we can do all of that. And we have budgeted money for that. So this is going to capture 60,900, almost 61,000. The math is 29 times $175, median between 150 to 200, times 12 months. So this is a plan that we have to decrease expenses, increase rent in more ways than one. Everything that you see in the exterior value add is good to have. The world is not breaking apart. I don't want to unnecessarily spend on something which cannot be directly related to advancing rent or increasing rent. So all this is good to have, but if as and when required, if we have to trim trees because they are touching the roof, or if some exterior paint touch up is required, we will fix it. But all those areas that you see in exterior is good to have for now. That's value add opportunity. Sorry, we spent some time, but that was important. In terms of investment class, I had two classes. I had because we closed one class already. I had class A and class B. Everything in class A and class B is the same, but I'll tell you the difference. Class A was a bigger ticket. We were expecting a ticket of at least 100,000 plus, like 150, 200, so on and so forth. Class A will get a preferred return of 17% year over year, but there will be no participation in profit. At the time of profit from sale, that will be distributed only to Class B and GPs. Class A will not get anything because they are essentially income generators. They are getting 17% preferred. So they get 17% before a single dollar is paid to Class B. So they have a higher distribution order. They get 17%. Therefore, no profit on upsale. Both the classes A and B get depreciation. So there is a concept of depreciation which we share with everyone. Regardless of a dollar invested in A or B or GP, everybody gets the same depreciation. So depreciation both classes will get. Now B gets only 7% every year after playing class A, but they get a fat profit on sale at the end of year 5, which takes their annualized return to 26%. For now, Class A raise is complete. We wanted to raise only 750K because anything more will affect my cash flow. We raised that money, so we don't need any Class A anymore. Class B is almost complete. We are looking at five. This is 600, but we have got 100, so we need 500K more. We are looking at Class B 500K. For now, we have enough money to close, but we are raising the remaining 500 because we need it for capex, reserves, all that good stuff. But at the time of closing needs only X amount of money. So we have enough money to close for now. But we are raising money to complete the overall raise. This was an example of Class A where you can see you only get 17% reserve return and your member capital back in year 5, but you get good depreciation, same depreciation, but the raise is complete. Class B, you get 7% every year on 100,000. In year 5, I return 100,000, but you get 95,000 profit from sale at the end of year 5. This itself takes your total return of investment to 230,000 or 2.3% and annualized to 26%. So how I compute 95,000 is in the next slide. In addition to this, you get these depreciation. So 19 plus 29, 48,000 depreciation you get in 5 years on 100,000 investment. If it is 200,000, then it is 96,000, so on and so forth. This is the minimal depreciation you will need. I will provide a tax form called K1, K-1. That tax form will have the returns, profit from sale, depreciation every year, and you have to work with your CPA to find how best can you offset your current taxable income with this depreciation. So work with your CPA. K1 form I will give. You will find depreciation every year, and that is in addition to the returns that you get. Now, this was the second slide. If I had to share three slides, this is the second slide. The question is, so Freddie Mac is like, I'm convinced now, how will you put something together that tells me your exit strategy? So the exit strategy is as follows. Number one, and there are just 3 points here, is what is the trigger to exit? The trigger to exit is as soon as I get the NOI to the 600K mark. That is where I will nudge my broker softly and say, hey, let's start looking for opportunities. How is the market reacting? What is the impact of interest rate on current environment? When is the best time I can get the best price for this property? That discussion comes when you're closer to your NOI reaching 600K. Now, the math is pretty simple here. NOI divided by cap rate is your value. So I can control the NOI, but I cannot control the cap rate. Just like Bloomberg and other agencies like Morningstar, they provide evaluation on your stock markets. We have CoStar for commercial real estate investment. CoStar, there are some reports coming from CBRE. So CoStar is a Bible for us. CoStar projection talks about how the cap rate is going to flow in the next 5 years. Lower the cap rate, higher the value for us. So if you see that graph on number 2, you see greater Houston markets, which include submarkets also. The expectation in 2030 is the cap rate to reach 6%, slightly over 6%. So I'm keeping it 6 to 6.25%. So now look at the table number 3 and only focus on the highlighted areas. So my target is an NOI of 612. This is a precise number which comes from Proforma, which I will show you. My target is the cap rate as per CoStar to be around 6%. If those two things hold true, 6112 divided by 6% is 10.2 million. 10.2 million is enough for me to pay all of you 95,000 in that example and give you a total return of 26%, highlighted in the same color here, 26%. So now any agency like Freddie Mac and Fannie Mac will say, okay, convinced, that's what they said. Now give me a sensitivity. So then I picked up a sensitivity for both the pillars, NOI and cap rate. So for NOI, if you see, I have said I may have 5% more NOI or 5% less NOI. Cap rate, I may have in 25 basis point lower or higher. So based on that, the worst case scenario is lower NOI and higher cap rate. So I will only get 9.3 million. So I said lower. And the best case scenario is higher NOI and lower cap rate. That gives me 11.78. This low and high gives me 23.1 to 28.4%. So while my target is to hit 26, I could probably land at 23.1 or 28.4. So look at all the possibilities of NOI and cap rate changes as we decide to make a decision for this. That said, the next thing here is what are the next steps? Nothing that I'm talking about this is going through some private website or anything. I have taken a license for cash flow portal. It's a fully streamlined, three layers of security, SEC compliant, fully digitized syndication software. It manages the entire deal from capital raising, investor communications, sending out K1 forms, calculation, everything in a SaaS based software. It is costing me $4,000 every year, but well worth it because I need something which is more scalable. As I get to my next deal before 2025, there will be a second one, so on and so forth. So I want something, the back end system has to be scalable and secured. I want to have a peaceful sleep that, your private data is not compromised somewhere else. It is going through a structured platform. So the easiest is, and because we are so close to the closing is May 30th. So here I've said, sign up. It takes you 2 minutes to click this link or do this scan, create an account, view all the offering documents, complete the signature. This takes 10 minutes. Once you do that, because it is 506B, you either upload a accreditation letter or you trigger the accreditation from the cash flow portal. So cash flow portal will has a parallel markets as a partner. They will ask you questions and then you upload a few things and they'll issue a certificate. The other option is if you are not happy to do so, I have a CP on my side who can take your documents and issue you a letter. Either which ways, do the part and then wire the investment. So date wise, I'm looking at if you are interested, complete the signing by this week, and by next week, May 28, May 30, complete the funding. That's how it is. And everything from here is appendix. This is a 5-year pro forma where I'm talking about how am I going to increase from 374 to 612. And to make the story more meaningful, I have said, look at number one, I'm doing the rent capture in a certain way. Look at number two, some expenses are increasing because I'm buying this property at 5.9 million, replacement value is increasing, and I'm doing something for the water conservation program. So this gives you an idea of everything that we are doing heavily in the first 2 years to get a larger income, tighter expenses, and a better NOI. So this is a story that takes you from 374 to 612. For this, the next is fee disclosure. How much money goes to the GP? So acquisition fee 2%, asset management 3%, exit transaction fee 2%, 70-30 split for up to 26%. Beyond 26% is 50-50 split. Refi is 2%, but I don't see a chance of refi because this is a 10-year fixed loan. If I refi in year 2 or 3, I have to pay 3 years of penalty. And then paying 3 years of penalty, paying 200,000 of refi cost, and then expecting proceeds or cash out is difficult. So refi color coded saying that there may be a refi, but I think that situation is difficult. This is very simple. I'm buying a property at 5.9, acquisition fee, add closing cost, add capex reserves, total project cost 6.5. We are projecting 4.2 million, but this could be 4. So between 4 and 4.2 million. And remaining money we are raising. These are all standard. There is a scope of value add because Vail Apartments is ranking number 4 out of 5. Everybody is higher dollar per square feet except Vail and Harvest Moon. We are the laggards of the class, which is good because this gives me a scope to value add and take the property to the next level. This we spent almost $10,000 on due diligence, hiring 4 licensed contractors for HVAC, roofer, electrician, general contractor. We hired a property management company walking through all 60 units. So Freddie Mac said, I looked at everything. I need one slide that puts everything together. So this is the slide. We did an interior walkthrough, exterior walkthrough, audit validation. We have all the reports in terms of what needs to be fixed now, which is a much smaller list versus keep on looking at it or supervising it. This may need some help later. Uh, End of day, we have to ensure that everything that comes out of due diligence, you have adequately budgeted for it. So our budget for repairs and our budget for capex is higher than the total recommendations coming out of due diligence. Plus, the seller added $40,000 as a credit from his side. So that gives us almost 300,000 plus money, uh, adequate enough to do the upgrades and fix a few small things. Risk factors, we discuss almost all of them. We are in a decent category number 5. If there is a prolonged downturn or something, I expect people from class A to downgrade to class B. So we will expect some people from there. Interest rate fluctuation, I don't see any because we are Freddie Mac loan is a 10-year fixed year loan. Liquidity, Freddie Mac expects us to raise 7.5%. As liquidity, we are raising close to 10%. Expense control, current group is doing a good job. Our property management will do better because we are moving the leasing center in the market, tightening expenses by doing proactive repairs, etc. So expense control will also be decent. This would not have been possible by sharing the credit with all of them, from a syndication attorney to property tax litigation to Oak Leaf Management, the remote leasing and property company, to the CPA who will manage the syndication accounting, to cost segregation expert who will compute the depreciation on K1 forms for all of us. So basically, that's where I am. That was it. Ask me any questions. Do you want me to go to a certain slide and answer questions? Feel free to do so.
Hello, this is Fred. I have a couple of questions if
Please.
I can keep them in my head long enough while I'm driving. One is now you were speaking about the accreditation. Now I am Series 765 licensed advisor and broker. Do I need to go through the accreditation in order to invest?
Okay. I know what the criterias are. If somebody can share your email, you said 765. Can you give me a little bit more details about your license?
Yeah, I'm a licensed investment advisor broker to buy and sell securities. I know they spoke about accreditation, and
Yes.
as far as that, it's like I'm able to buy and sell stocks on the exchange
Yeah.
over Nasdaq and the bond market, and those things. And a
Okay.
financial advisor basically having a fiduciary responsibility to help clients, make financial decisions, et cetera, et cetera.
And that license is called as 765. Is that what it
No,
is?
it's two licenses. Series 7 is for a brokerage firm,
Yeah.
and a Series 65 is an investment advisory license
Okay.
by FINRA and SEC.
Okay.
So that was one. I mean, I can probably also check with the masters because I'm in the group as well.
Yeah.
But could you expand on two things?
Yes.
One is, if you do come in one of the GP positions, do we actually have a role and responsibility, or is it that you're just giving us a status of GP?
Currently, the only position open for GP in Vail is that of capital raising.
Okay.
Because we are having this discussion at this point in the deal, the other positions like asset management or putting your hard money or acquiring, finding, all of these are taken. The only available GP position is the capital raise.
Okay. Okay.
Yeah.
I just wanted to verify that. Yeah, I wasn't sure when you say the GP. I mean, because I know we're building out our team, and basically we're learning from your platform as well.
Yeah.
As for what happens if we do bring someone in, do they need to? Okay, so one other position, you said that if the person has the balance sheet or capital or I don't know exactly what that position is, to become a GP, to show that they had the financial responsibility or capability to support the deal. What exactly is that number? I know the deal is worth $5 million. So does the person have to have $5 million, or does the person have to have like enough to cover 1 year of payment or 2 years of payment, in order to obtain that status?
Yes, I'll explain. So whenever somebody talks about balance sheet partners, that essentially means that, like, for example, in Vail, my loan from Freddie Mac is 4.2 million. Okay. That means that Freddie Mac is looking at somebody who has a single balance sheet of at least 4.2 million and significant commercial real estate experience. So significant can be played as needed. For example, I have Sanjay on my side. So without divulging any private information, Sanjay does have significant experience and a balance sheet that is 4.2 million or higher. Now, bigger the deal, the significant experience is more important. For example, if we come up with a 25 million deal, they will really talk about how many deals have they done, how many doors have they done asset management for. Or the experience weighs in heavy as the deal gets bigger. This is a very small deal. In eyes of Freddie Mac, also it qualifies as SBL, small business loan. So they are a little lighter on the experience, but they are looking at a single balance sheet of 4.2 million. Does that answer your question?
Okay. Yeah.
Yeah.
And probably lastly.
In larger deals, let's say 25. So we were chasing a 25 million deal in last year, and we could not find a single person with such a large balance sheet. So Freddie Mac agreed, come up with maximum 2 balance sheets. So if they are looking at 25 million, we brought 2 KP partners of 15 million and 10 million. That was workable. So, that's something I wanted to share.
Okay. All right. Appreciate that. And lastly,
yes, please.
Is now, if I basically do come in as a capital raiser, and I bring in someone with 100,000, but say I come up with less or none, does that qualify or no?
That qualifies. If you come purely as a capital raiser and don't invest anything personally, but bring somebody, let's say 100,000, that qualifies you. What I need is, I need whichever LLC you have or your personal name, which can take I need that information to cut a check for you. And the amount is 15%, like I discussed. 10% of that is paid 60 days from closing, and the remaining 90% at the time of exit. So if you don't invest a single dollar but bring somebody with 100,000, that's perfectly fine.
Okay. And one last question is, and it came in my mind and went out of my head. Go ahead and speak. I'll see if I can remember what it was.
Yeah. The only request is whosoever investor you're getting should be accredited at this stage. We will go through the accreditation process, but at least in your mind, you should know that the investor enough saying that I know for the fact that he's accredited. If you have a larger confidence that your investor is accredited, that's all counts. We can go through the process of accreditation, that's fine. But at least you know that he or she is accredited. And the
Right.
funds have to come by May 30th. I know it's a short time period, but if somebody is waiting for funds to come later, then we would rather prefer somebody who has funds ready by May 30th than otherwise.
Okay.
Yeah.
Thank you.
Other questions?
Okay. I remember the last question. So you saying right now you have the capital to close. You guys are just continuing to gather the capex. So a risk of the deal not closing is kind of
Zero.
low. Am I correct?
Correct. So at the time of close, basically all we need is the down payment of the remaining money that Freddie Mac is not paying you and some closing cost. The title company or the closing escrow agent only needs this money. He doesn't need all the closing cost. He doesn't need to worry about I'm paying you guys 10% of your GP share now. He doesn't need to worry about all this. He also doesn't care about capex and reserves because they are like, oh, you handle all that. I just need this much money. So for closing, we need 1.85 and I have close to 1.9. So enough money to close. So the risk is very low. So we are good there.
All right. Thank you.
Yeah. Most welcome. Most welcome. Andrea, Cornelia, Delmi, happy to
I've
answer.
heard it over and over. I love each time that I hear it. So I don't have any specific questions. I was just asking Cornelia. Did she
Okay.
get her questions answered? Miss Delmy, I'm not sure.
Yes, thank you so much. So I'm just like you. I don't have any specific questions. I'm trying to absorb all the information as well. And I'm learning in the process as well. So thank you everyone for allowing me to
Wonderful.
call.
Yeah. So what I'll do is I'll put an email together, provide you link of this presentation. I'll wait for the recording to complete, upload it, send you a link for that. And the email will also have how to invest. So you click the link. So you don't have to essentially open the deck and all that good stuff. Just click the link and go through the process. There are investors who are like, hey, why don't you get on a call with me and we can do this process together? It takes 10 minutes. If that's the case for your investors, I'm more than happy to put a call together with you and your investor and we can walk through the process and complete the e-signatures in 10 minutes. Happy to do so. All that you will find in the email. Any more questions? I'm just a phone call away or a text away.
Thank you so much.
Most welcome. Thank you, Frederick, Delmi, Cornelia, Andrea. Thank you so much. Any questions, feel free to ask.
Okay, thank you. I think you answered
Thank you very much.
in the first part. Thank you.
Hey, thank you. Have a good evening. Goodbye.
Thanks.
Bye.